In this video, we're going to discuss the concept of free cash flow. So what is free cash flow? That's the amount of money that's left over at the end of the year after we've paid all of our expenses of operations. We have purchased or changed the amounts of our accounts receivable, our current assets, and our current liabilities. We've also purchased all of the assets that we want to purchase for the year. So there is nothing left for us to spend any money on except on our investors. So what money should they receive? Well, our bond holders want interest to be paid, and they may also be expecting some reduction of principal. But of course, we could also increase the amount of debt we have. That would, of course, be a cash inflow. What about shareholders? Of course, we could sell more stock, issue more stock, but we could also pay dividends and or we could actually repurchase some stock. So those are all the cash flows that could go to our investors. So this is just a picture, if you will, of how safe that cash flow, that amount of cash is for those investors. Now, this data I've gathered from the Molson Coors Company, and I have 3 years worth of data here, 18, 19, and 2020. I downloaded this from Zacks.com, and I've just input the data that I need for this. So as far as income kinds of things, we need the net income, we need non-cash expenses, we need EBIT. Now the net income, if you're not given this, you may have to calculate that. So what do we need? We need EBIT, you need interest, you need to know the tax rate. And those things are all on this sheet. As far as current assets, you need to know the beginning and ending amounts for current assets for the year. Current liabilities, you need the beginning and ending amounts, but you don't want to include any current amounts of debt or notes payable. The reason for this is we want to show the cash available to our investors. And of course, bonds are an investment by our creditors. Likewise, notes payable is an interest-bearing instrument from our creditors. So we want to pull that out and not use that in our free cash flow calculation. It's part of what we're analyzing here. We also need the change in fixed assets, beginning and ending. We need to know something about the total common equity of the company, again, beginning and ending. Likewise for long-term debt. And here is where we'll put the notes payable, if there are notes payable for the company. Now, there are some other things we may want to do. Dividend payments, we might need the tax rate, or maybe you just need the tax expense. You could put that here as well. And then the interest expense for the company. So again, all of this data came from the financial statements of the company. So what does this tell us about our company? Well, cash flow after tax. At the end of the year, we have net income. However, net income is not a cash flow number. It's a profit line. So we want to add depreciation back to net income. So the actual cash flow after taxes for 18 and 19 are positive. 2020, we went negative. Well, why did we go negative? Well, we have negative earnings for the year. So that was a bit of a problem. Next, operating cash flow. What cash was created by the company itself, just from operations. And you can see every year we have some, but it has been declining. And in 2020, we had a terrible fall, right? So it's like a third of what it was in 2019. It's 20% of what it was in 2018. Now, we do know that COVID happened, and this created lots of problems for everybody, but this is a major concern for the company. How do we change our net current assets? Well, you see here it's negative in 2019. What that means is we purchased or we increased our current asset base more than what we increased our current liability base. You just spent more money there than income. And this last year, what this means, again, it's $100. That means we have a cash inflow. That means more cash came in from current liabilities than went out from purchasing current assets. Likewise, for plants and equipment, again, you can see we're increasing assets every year. This last year, a little bit a lack. So now we need to calculate the free cash flow. And the free cash flow is just the operating cash flows minus the net current asset investments minus the net fixed asset investments. So this tells us we have $1,148 left over to do something with. Well, what are we going to do with that money? That's money that we can pay interest or buy back debt. We can pay dividends. We can buy back stock, right? So there's lots of things we can do with this cash. Not that we're going to, but one thing to kind of keep in mind is this is not money that now we're going to try to invest it in assets. We've already done all of that. This just shows us how much safety we have. And as you can see, 2020 was a pretty bad year. We actually have a negative free cash flow number. Now, that's not always a kiss of death because it happens frequently, especially if we're expanding, right? What if we bought a major company, right? We bought a major company in 2018. It cost us $2,000. Well, this number would be $2,800. So obviously this number now is negative $2,000, right? So having negative free cash flow is not terrible. You don't want a lot of years of that, but especially in expansion times, it could be negative. What we ultimately get is a little bit of an analysis of, well, who gets this cash flow or where does it go, right? So this year we had $1,148 came to the company. That's the cash flow of the company. Where did that money go? So we spent $1,985 out of the $1,100 on creditors. So how can you spend $1,900 if you only have $1,100? That's because one way or another, we got some money from our shareholders. And shareholders helped us pay our creditors this year. The next year, again, $1,448 came in. We had to pay $1,000 to our creditors. $444 then is cash flow that could go to our shareholders. And likewise, we had this downturn this year where we had a negative cash flow. We still had to pay our creditors, right? Interest. We still had to make those payments. And we may have bought some debt or whatever, paid back some debt or something. So that means, again, in this last year, that shareholders have kicked in a fair amount of their cash to help cover the creditors. So again, it just gives us a picture of where this money goes, who does it, in quotes, belong to, and how can we plan to move forward from this particular kind of situation. So again, thanks for watching the video. Look forward to see you soon.